Welcome back to this very last Indianomics of the financial year FY25. It's called Looking Back, Looking Forward, and I've been speaking with Nilesh Shah of Kotak, Soumya Kanti Ghosh of SBI, and Rajiv Anand of Axis. Gentlemen, thank you very much for your patience. Soumya, the big talking point was the rupee last 4 weeks, last 4 months actually. I thought I took home from FY25 the resilience of India's services exports. FY25 February was an eye-opener with the goods plus services number being more than the imports. It was a 1-month surplus. What is your sense of the year ahead? Is the rupee has the rupee already seen the highs of the year, 87.95?
Yeah, I think
lows of the year.
Yeah. And that's a very interesting point. Actually, if you look into the goods and services exports breakdown in the last couple of years, the gap has been consistently narrowing. And this year, actually, even as for an export goods front, we may end up with a year of maybe around 1% growth. And for the services sector, the growth rate could be closer to 7 to 8%, which means that around 360 billion of service exports against 430 to 35 billion of goods exports. And most probably, given the abundance of these global convention centers and the emphasis on the service sector, I think next year is unlikely to be a different. And I will not be surprised in the next couple of years, the service exports actually catches up with the goods exports at the pace which that service exports are growing. And that is also having a very comforting factor on the external sector, with the current account deficit and the balance of payments are remaining at significantly manageable levels, contrary to earlier expectations. You must remember that in the last 2 years back, we had an expectation of current account deficit being closer more than 2.5%.
Yes.
But it ended up lower than 1.5% at the end. So I think that's will be the most important factor in terms of paving the way for a positive rupee outlook over the medium term. In the short term, I think there will be tariff-related disruptions. I understand that the Indian government is trying to strike out a deal on the tariff issues with the US. But my sense is that most part of the uncertainty of the rupee possibly seems to be over, even though there will be minor disruptions in both directions, I think in the positive and negative one. And my sense is that we are actually looking more at a scenario which happened in 2016 when the Trump had taken over, when the rupee traveled the same trajectory. It depreciated by close to 3% till the end of January. Then it appreciated by close to 5.5%. While such a strong, and your graph shows that the rupee has already appreciated by around it has pulled back 2.5% in the last 2 months. So my sense is that there could be some possibility of a pullback. Regarding a range for the rupee, it looks difficult to say, but my sense is that it will mostly remain in the range of around, say, 87 to 87.5 or within 88. So I think that should be the range in the medium term.
87, 88. Okay. But Nilesh, to start where you left us off, that there will be, capital market disruptions, and therefore you're not, very inclined towards capital market plays. Are we going to see major headwinds from global financial markets? Are you worried about headline indexes?
Undoubtedly, yes. It's difficult to predict what President Trump will do and how it will impact geopolitics as well as supply chain. While his drill baby drill policy will be favorable to India from oil price point of view, there could be some headwinds because of tariff policy or other unpredictable steps. On the currency side, Latha, I just want to add one point. Our currency is more likely to track Chinese yuan, and how China appreciates or depreciates its currency, that's going to have an impact on our rupee movement.
Oh, that's fair. And in fact, all of us rupee reporters are actually looking more at the yuan rupee exchange rate. And it's, stuck to that 11-12. I mean, you must admire the Reserve Bank to bring it from 10 to 12 in the last 10 years so that we compete with China more effectively. It's a less appreciated fact. I take your point of that. Rajiv, I wanted to ask you about credit growth. I mean, what are the chances it goes back towards that 14% mark? Even 16 we saw 2 years ago. Because both of you are talking about interest rates at probably 5.75 repo rate, maybe even 5.5, given the way inflation is trending. Do you see that good enough to see Capex growth? Or will this global uncertainty keep Capex loan demand weak?
I think on the corporate side, there are two things happening. I think there is certainly a reluctance. Is Capex happening? The answer is yes. Is it enough? I think that's the question to ask. Is that enough at this point in time? The answer is clearly no. And I think clearly there is a reluctance among promoters to increase capacities at this point in time. Money is not a problem. They continue to generate very strong cash flows. The ability of corporate banks to be able to lend or support this is not a problem. There is adequate money in the capital markets, in the equity markets for them to fund it. So funding is not a problem. I think there is an intent issue, and I think that is something that that is driven by various issues. Perhaps they're not seeing the kind of growth that we are seeing. Perhaps they're worried about China dumping and so on and so forth. And I think some better understanding of why promoters are reluctant to increase capacities is certainly warranted. But I'm seeing very strong growth on the MSME side. We are a very large player there. We continue to grow very strongly within that space. The book is from a quality perspective is benign. It's a very profitable business for us, and I do believe that what retail was over the last decade or so, MSME will be over the next decade or so.
Soumya, too many questions to ask, but your guess of the Capex cycle and a word on Indian macros.
The disappointing part is that the private investment as a percentage of GDP is still equivalent to what was at FY20 level. So that needs to pick up. But the good thing is that if you look into the breakup of the gross bank credit, which is going at around 8.8% on a year to date, within that the SME credit is actually growing in more than 10%. So that's a positive thing. So possibly some shift has happened from the large industry to the small industry, which is good for the Indian markets. And regarding the Indian macros, I think, yes, all the numbers look better. The fiscal numbers of this center looks better. The borrowing numbers looks better. The interest rate and exchange rate outlook looks fine. So overall, I think Indian macro is steady, resilient, and we actually, I'll not be surprised if at the end of the year, the growth rate actually is higher than 6.5%, which is the current market consensus.
All points taken. Nilesh, last word from you. What is your, I was expecting actually a rating upgrade for India in FY26 because the macros look so good, both on the external and on the fiscal front. Your best guess on flows to India and India's relative weight in global indexes. How will it pan out?
On the flow side, we believe सुबह का भूला शाम को घर लौट आएगा और शायद दोपहर को ही वापस आ जाएगा. But a couple of points from my side on Capex. One humble submission to Indian entrepreneur. If you are not investing, fair enough. Please give some small portion of your surplus to young talent in your company and let them do some experiment. I'm sure they will be able to create many good startups, which will increase the Capex. The second point, as country, we are looking at power shortages. Already non-solar hour power rates are multiple times what is available during solar hours. And we need to do serious thinking about power so that this growth can be sustained. If we can manage those challenges on private Capex and power shortages, I have no doubt in my mind, our governance and our growth model will ensure that FPIs continue to be an investor in India rather than taking profit home.
Okay. Well, gentlemen, I'll never run out of questions. Thank you very much indeed for joining me with your take. We didn't even touch tariffs for the simple reason that we can't speak the last word on that. Despite that headwind, the expectation is that we are going to be in a fine place in FY26. That's it from this edition of Indianomics. Thanks so much for watching.